My name is Jeff Tomlin, and the purpose of this video is to give you a basic understanding of federally tax-qualified long-term care insurance. This type of long-term care insurance was created in 1996, and it was a part of the HIPAA Privacy Act. When you purchase long-term care insurance, you purchase access to a pool of money. You have immediate access to the entire pool of money from the effective date of your contract. A typical pool of money might be $200,000 to $300,000 per person. Funds can be used for in-home care or facility care. For example, if your premium were $200, then based on your initial premium payment of $200, you would have access to the entire $200,000 to $300,000 of funds in your pool. And as a rule of thumb, a lifetime of premiums will never add up to more than the cost of paying cash for 1 year in a nursing home. When you design your plan, you choose a maximum rate at which you can access funds for care. The most important rider to consider is optional inflation protection. Inflation protection will grow your pool of funds over time. There's inflation based on simple inflation rates, 3%, 5%, 4%, depends on the insurance company. There's compound inflation, and there's consumer price index based inflation. There are a lot of other options in addition to inflation protection, but there's only one other that I want to cover here in a minute. So for the purposes of this explanation, let's just keep it simple. There are only 3 choices to make when you design your plan. Only 3 things you have to decide on. How much will it pay per month? How long will it pay for? And when will it start? In other words, after the commencement of the need for care, there's an elimination period built into the plan, and you choose how long that is. And at the end of that elimination period, then the plan starts paying benefits. So let's talk a little bit about what happens when you need care. How does the payout work once you qualify? Well, most of the plans that are out there are called reimbursement plans, and that means that when you accrue charges for care, you submit the bill then to the insurance company, and they reimburse you for the cost of that care. This is, of course, after you qualify to receive benefits. And speaking of benefits, if you do collect benefits out of your policy, you'll be exempt from paying further premiums for the duration of that care. In other words, it just wouldn't make sense to continue paying premium at the same time you're collecting insurance benefits from your policy. So as an example, if you have a maximum payout of $6,000 per month and you choose a benefit duration of 3 years, if you access your funds at the maximum rate, then in 3 years your pool of money will be exhausted. However, let's say you have that same plan, your plan has a maximum payout of $6,000 per month, but let's say that you find care that's less expensive, or maybe you don't need that high level of care. Maybe just some care at home or an assisted living facility would take care of your needs, and that's less expensive than a nursing home, for example. So if you spend your money at a slower pace, say you spend your money at a pace of $3,000 per month, your pool of money will last longer. And you're never cut off from benefits in these plans unless you spend every last nickel in your pool. So if you were spending money at a rate of $3,000 per month, that would last you 6 years. It would last twice as long. The only other rider I want to cover today is called shared care. And this is the best way to leverage your premium dollars if you are a couple, if you have a spouse or partner. So if your spouse or your partner and yourself apply to the same insurance company at the same time, same benefits, and you both request shared care off of each other's policies, you'll have access to each other's pool of money at claim time. And shared care adds about 20% to your premium, but that's far less expensive than both of you buying twice as much coverage as you would expect. So in this case, each partner has a pool of money worth $200,000, and they have the shared care rider. And then one partner goes on claim. If they drain their entire pool of money. If they spend all $200,000, then at that point they have access to their partner's pool of money, and they can spend up to the other $200,000. Or in other words, they have access to both. Either partner has access to both pools of money with the shared care rider. So this is the first video I've made, and I'll be making more videos and adding a lot more resources to my page at tbplan.com/planning. So I appreciate your watching, and please go check out the website for more information. Thanks.